Welcome to SST College of Arts and Commerce. You're watching SST Edupedia. I'm Assistant Professor Varsha Sawlani. In this lecture, we are going to learn the topic capital market. This is a very hot topic which is in majority of the courses, such as it is in TYBAF, Sem 6 Indian Economy, SYBCom Sem 4 Commerce 4, TYBCom Sem 6 Economics 6 Paper 6. So capital market is a part of financial market. The financial market is divided into two parts, capital market and money market. In the previous lecture, I have explained money market and its instrument. Now in this lecture, we will see capital market. The capital market is regulated by SEBI. In this market, the long-term securities are being dealt. The market is further divided into primary market and secondary market. So, in capital market, the securities such as shares, debentures, bonds, other securities are being traded. It is a long-term securities having the maturity period of more than 3 to 5 years. In this market, the trading is done by the individual investors as well as the companies. This market is being regulated by Securities and Exchange Board of India, that is SEBI, which was established in the year 1992. The structure of Indian capital market, the Indian capital market is bifurcated broadly into four types. Number one is government securities market, which is also called it as gilt-edged market, where government securities are being traded, that is bonds, debentures, etc. The second is institutional securities market, where the new issue, that is primary market, and the old issues are being traded, that is secondary market, which we called it as a stock exchanges. The third is departmental financial institutions. These institutions, DFIs, developmental financial institutions, are IFCI, that is Industrial Finance Corporation of India, which was established in the year 1948, ICICI, Industrial Credit Investment Corporation of India, which was established in the year 1994, SFC, that is Securities and Future Commissions, which was established in the year 1989, then IDBI, that is Industrial Development Bank of India, which was established in the year 1964, then IIBI, that is Industrial Investment Bank of India, which was established in the year 1971, and UTI, Unit Trust of India, which was established in the year 1964. These are the developmental institutions which helps the institutions to deal in the financial market, especially in the capital market. Next one is financial intermediaries. The financial intermediaries helps the buyers and sellers to do the trading in the stock market. Those financial intermediaries are merchant bankers, then there are the mutual funds companies, lease companies, venture capitalists, and other financial intermediaries, those who are helping the buyers and sellers to do the investment or to create the finance in the market. This is the entire structure of the Indian capital market. The capital market is divided into four: government securities, which is also called it as gilt-edged market. Then there are the industrial securities market, development financial market, and financial intermediaries. This entire capital market is bifurcated into fresh issues, which we called it as a primary market, and secondary market, which is deal in the already traded shares, already issued shares in the form of stock markets. So what is stock exchanges? The stock exchanges are nothing but the platforms where buyers and sellers come together and trade the stocks during a specified working hours. There are 23 recognized stock exchanges in India as per SEBI. Out of those 23 recognized stock markets, 2 are the major stock markets, NSE, National Stock Exchange, and BSE, Bombay Stock Exchange. Other rest 21 are the regional stock markets, which are such as Ahmedabad stock market, Kolkata stock market. Likewise, there are the 21 stock markets which are recognized by the SEBI, which fulfill the guidelines given by the Securities and Exchange Board of India. The stock market timings, the Indian stock market timings are, it starts from morning 9 a.m. till 3:30 p.m. So these are the timings during which the trading happens in the stock market. As I said, there are the two major stock markets. One is the National Stock Exchange, which is represented as NSE, and there its indices is Nifty. Indices are nothing but the total number of companies listed. Out of that, top 50 companies ka indices is Nifty. So the stock market NSE, National Stock Exchange, which was established in the year 1994, its indices is Nifty. Nifty 50. 50 is top 50 companies. Those are listed in the Nifty, in the NSE. Out of that, the 50 indices has been considered. The oldest stock market in India is BSE, Bombay Stock Exchange, which was established in the year 1875. The Bombay Stock Exchange has an indices called Sensex. The Sensex comprises of top 30 companies. So Nifty comprises of top 50 companies, which is the indices of NSE, and Sensex comprises of top 30 company, which is the indices of Bombay Stock Exchange. Now, entire market is bifurcated into whether if the market rises, अगर किसी भी share price में increment होता है, that market is called it as bull market. When the price goes up, it's called as a bull market, which is a optimism. Whenever the bull attacks to a person, it attacks by swinging up. So it is called as a bull market. When the market goes up, it's bull market. When the market falls down, when the price is going down, which is also called a pessimistic market, it's called bear market. So bear market is denoted as in red and bull market is denoted in green. As we have already discussed, this stock exchanges, these capital markets especially, are being regulated by Securities and Exchange Board of India. 1988 से ये form हुआ है, but came into effect from 1994. So this role of Securities and Exchange Board of India in the capital market is to promote and develop entire capital market, including primary market, secondary market, including intermediaries such as merchant bankers, mutual funds company, leasing finance company. These are the development of these intermediaries, the development of the gilt-edge market is the responsibility of the SEBI. Along with that, it acts as a regulatory. So the regulatory authority of capital market is SEBI. As we have discussed in the previous lecture, the money market has been regulated by RBI. This capital market has been regulated by SEBI. The main role of SEBI is to protect the rights of the investors, to educate them. The main purpose is education of the investors, where they can invest and they should have the proper knowledge before investing into a stock market. Then investors' grievances redressal. If investors is having any complaints related to any company which is listed into a stock market, the investors can put forward the complaint to the SEBI against any companies or any intermediaries which are listed to the stock market. Then framing different policies for primary market as well as framing different policies for secondary market. Primary market where new issues happen, fresh issues of the shares. Secondary market where already issued shares are being traded during that working hours 9 to 3:30. Second, then market surveillance, overall vigilance to the market to the n number of intermediaries, to the brokers, to the investors, the trading happening in the T+2 concept. So entire surveillance of the market is done by the SEBI. Then there is a institutional investment policy. Many institutions raises the funds from these markets. So which are the policies, which are the guidelines they have to fulfill, and facilitates the mobilization of resources. That is, the persons, those who are having the excess funds, can invest into a stock market, which helps the company for their growth and expansion. So this is the entire role of SEBI, that is Securities and Exchange Board of India, which regulates the stock market. Okay. This is the entire capital market brief introduction. Thank you for watching till last. Thank you.